I'm sure you guys are familiar with ticker Moat. This is an ETF, a growth ETF that has been exploding in popularity, and it follows a Warren Buffett style of investing, selecting for companies that have high, sustainable economic advantages that allow for above average market returns. And people seem to be a big fan of this strategy. There's over $10 billion in assets under management, and this trajectory has been exponential as of lately. But I'm here to tell you that there's a new ETF on the market that essentially has the same underlying strategy as Moat, but takes it to the next logical level. So if you're a fan of Moat and the idea behind it, you should be an even bigger fan of this new fund. I fully anticipate this to be a little bit controversial because of the extreme nature of this strategy, but I encourage you to have an open mind, listen, and let me know in the comments what you think. So before getting to this new ETF, let's begin by defining what exactly an economic moat is so we can better understand the strategy of this very popular ETF. So the term economic moat was popularized by Warren Buffett and refers to a business's ability to maintain competitive advantages over its competitors in order to protect its long-term profits and market share. These competitive advantages can come in many forms. A cost advantage. When firms achieve economies of scale, this is when they become more efficient. They can impose high switching costs on the consumer, have intangible assets like patents, other IP. For example, Apple certainly has an economic moat, and they say here the primary moat, because they have many, is innovation. They created products that simply did not exist before. There was no competition because no other company had that innovation and those products. Of course, nowadays, companies have caught up. There's more competition. And we see Apple building up their economic moat mostly in terms of switching cost. Apple likes to build an ecosystem where all their products work well together, deliver value to the consumer, and switching away from that is not easy. So to put it simply, an economic moat is a means to keep competition far away from the company to maintain above average profits and return to the investor over the long run. And more often than not, they establish an economic moat by being a more efficient company, delivering value to customers, identifying opportunity, being innovative. That's how they keep competition away. It's not through being anti-competitive, it's by being hyper-competitive. If you guys took Econ 101, you might be familiar with the concept of perfect competition. And this is essentially the exact opposite situation as a company with competitive advantages. Because in perfect competition, companies have no edge over their competitors. Products are not differentiated, they do not have pricing power, and there's also no innovation. Everything is the same. And the key point here is if a company does somehow begin to earn excess profits, that will attract additional competition. There'll be new entrances in the market, and eventually all that excess profit will be competed away. So from the investing perspective, an economic advantage is certainly something you want. But if you really think about it, when we talk about strong, insurmountable economic advantages, it's very difficult to compete with these companies. The next ultimate level to this is a monopoly. So a monopoly is a business that is characterized by a lack of competition and a entrenched market position. A monopoly, or at least an oligopoly market setup, are companies that have extreme economic advantages and their products are extremely differentiated and essential to consumers. Now, I do want to stop and acknowledge that the term monopoly has some very negative connotations associated with it. They're viewed as non-competitive, they exploit consumers, but at least right now in time, the current monopolies that we do or do not have, they're in their dominant economic position because of their extreme economic moat. And they built up this economic moat by being hyper competitive and outcompeting the rest of the competition, investing more, being more innovative, and delivering supreme value to consumers. That's the only way they get to this extreme level of monopolistic success. And don't be confused, in order to maintain this position, they need to continuously innovate and drive value to consumers. If a company doesn't do that, they don't innovate, they just raise prices and take advantage, then eventually a new company will come along, be more innovative, offer more value, and these companies will lose their economic advantage. A quick little modern day example I can give you on this is Amazon. They are about to be sued based off of antitrust violations, but Amazon is one of the most innovative growth-driving companies to ever exist. In 2020 alone, Amazon invested over $34 billion in American infrastructure and created over 400,000 jobs. So I think it's safe to say Amazon has a positive impact on the growth of the US economy. But even as a consumer, think about all the value Amazon as a company has delivered to you. They've created a centralized marketplace where you can buy essentially any item you want, have free and unlimited 30-day returns, and fast one-day deliveries. So yeah, it is difficult to compete with Amazon, but that's because they are such an effective company. They invest, they innovate, and deliver an extreme amount of value to consumers. So that's why I'm saying an economic moat, a sustainable competitive advantage that allows a company to be differentiated, deliver more value, and thus allows a company to both generate and sustain above average market profits is essential. And a monopoly or an oligopoly market environment is the ultimate destination here. A simple way of putting this is competition is for losers. Extreme competition just means that all your economic profits are competed away. And that finally brings us to the ETF of today's video, ticker TOL. And this is a collection of monopolies and oligopolies. So these are companies that have immense value to consumers with very few alternatives. Because of that differentiation, they have pricing power. They also are defensive. There's high barriers to entry. It's very difficult to compete with them. Stable defensive revenue growth and quality businesses with that sustainable competitive advantage that drives their high returns over the long run. And these right here are the top 10 holdings. Number 1 is S&P Global. Number 2 is Moody's Corp. And both these companies are in a duopoly market situation. They're both rating agencies. And if the name S&P Global looks familiar, it's because they are the maker of the S&P 500 index along with many other indexes. So everybody that invests in the S&P 500 pays money to S&P Global. We also see Visa down here. This is another duopoly situation with MasterCard. The only thing I don't like about this ETF is how new it is. It was created in May of 2023, and it only has about 6 million in assets under management. So unfortunately, we can't benchmark it against Moat or the S&P to see its long-term performance. But based off of simple market dynamics and the success of Moat, I think this ETF, ticker TOL, has a bright future ahead of it. But let me know your thoughts in the comments. I hope you guys enjoyed, and I'll see you in the next one.